Hi there, you're watching Critical Trading, channel for traders series about systematic and algorithmic trading. My name is David, and in today's video, I'm going to show you how to beat the market by picking random stocks. Yes, you heard that right. You can get the same or better return with lower risk compared to just buying the US index fund such as the SPY by buying stocks at random. Orange equity curve is the visual representation of a growth of $100,000 if you just bought the SPY, which is the fund that tracks the overall US stock market, represented by the S&P 500 index. This equity curve includes trading commissions you'd pay and takes dividends you'd receive into the account as well. It's worth noting that the S&P 500 index is an aggregate of 500 different stocks, and these are selected based on certain criteria, the market capitalization being one of them, I believe. And this effectively makes the S&P 500 a trading system, since there are rules that dictate what stocks will be part of it. The green equity curve, on the other hand, is the result of a simulation I made for the purposes of this video, where each month I took 20 stocks that were part of the S&P 500 at a time and selected these randomly. There were no rules whatsoever as to how the stocks were selected. I ran the simulation 250 times using Python, where the green equity curve is the median of all 250 simulations. So if no rules were used to pick stocks, how is it possible that this random stock picking was able to beat the market, even after the trading commissions were taken into the account? Well, this was done thanks to one particular risk management and position sizing technique that I'd like to share with you today. Had I not used this technique, the random stock picking would not be able to beat the index. Let me show you what this technique is all about so that you can implement it in your own trading. Now, before we continue though, please do understand that this random stock picking is not an actual trading strategy that I'm presenting here. That's not the point of this video. The takeaway here will be the position sizing technique that you can use in your own trading strategies, which will likely improve their risk profile. So I've got a list of 20 stocks picked at random, so no rules used whatsoever. Before buying all these, what I want to understand is how volatile each stock is. I'm using an indicator called ATR, which I'm sure you're familiar with. For this purpose, we can see that the ATR can vary across different stocks quite a bit. Let's say we start with $100,000. Given that we buy all these 20 randomly picked stocks, typically we would just take the 100K capital and divide it by 20 to arrive at how much to allocate to each stock. Now, this approach has a flaw though. It ignores the fact that the volatility varies among different stocks, which would result in more volatile stocks having greater impact on our capital, where a loss on a single volatile stock could erase profit on two less volatile stocks, for instance. Let me take this stock as an example. Its 20-day ATR reading at the time of when this stock was supposed to be selected at random is around 0.60. This means that on average, this stock made 60-cent move per share during the past 20 days. Now, if I take another randomly sampled stock as an example, we can see that this is a rather volatile stock when compared to the previous one, isn't it? The average daily move over the past 20 days is around $18 per share. Now, surely we need to account for this, and we need to ensure that our positions are bigger in less volatile stocks and smaller in more volatile stocks. This position sizing approach is called risk parity position sizing. Here's a formula that I use to size these randomly selected stocks. It takes an arbitrary constant 0.001 that I used in this calculation. This is to calculate an absolute value that represents 0.1% movement in our capital's value. We then take that value and divided by the stock's volatility. If I go back to the table, we can see that thanks to this formula, as the volatility of the stock increases, measured by its ATR, the quantity of shares to buy decreases, which is exactly what we want in order to achieve a risk parity across our overall portfolio that will consist of 20 different stocks. When visualized, we can see that some stocks were allocated very few shares, whereas others were allocated many more. And let's have a look at the results. All commissions included, as well as the dividends and the capital, was compounded in the test. Like I said before, I ran 250 runs of this simulation, and we can see that the last run, for example, managed to beat the S&P 500 on both average annual return as well as the maximum drawdown, 8 and 35% respectively, where the average annual return and drawdown, the S&P 500, was around 7 and 50% respectively during this period, which includes the global financial crisis as well. So this is not bad at all, given that all we do is pick random stocks each month and we just use a simple risk parity position size and formula. Now, this obviously isn't an actual trading system, but rather a demonstration of a simple risk management technique, like I said. And if you have existing strategies, be sure to try to implement this position sizing to see how does the performance improve. If you like this video and this is the kind of content you're looking for, then I suggest that you watch the video on the screen right now, as I think you will like it also. Thanks for watching. This is David at Critical Trading, signing out.